Allison. Good. How are you? You're going to sit over there. Josh is coming up. Is Claudia here? Did she arrive yet? She did not arrive yet, so we're going to have a smaller panel. Okay. What's that? We can bring one. Who wants to join our panel? Ready? Go. Christina, do you want to join? Or no? Anybody else? Steve, come on, get up here. He's not. Okay, we're just going to have a talk. This is great. I love it. Let's move this over here. He's not listening to you. He's shy. You know, I've never known Steve to be shy. You lost your chance. You want to come up now? Okay, come on up. We're gonna go in real time. Give me one of those chairs. So let's kick it off with talking about Steve from RRE is going to be joining us with Allison. And what's great is we've got very different styles of funds here. So I'll move back just a little bit. There you go. That's perfect. Okay, great. Did that break? No. Aside from Josh, because he already gave us his two-sentence intro of fund and focus, Allison, why don't you take it away? It would be great.
Hello. So I work at Time Warner, and we have a venture group. It's called Time Warner Investments, and the goal of our group is to invest in companies that are strategic to any of our divisions, which are now HBO, Warner Brothers, and Turner. So we are a video company focused on making films and television shows and digital content in the entertainment, news, and sports sectors. We invest anywhere from $2 to $10 million when we first go into a deal. So we're not super early stage. We're more, say, classic Series B and on, but sometimes we'll do Series A's. And we're pretty active. So we lead about half our deals. If we lead, we take a board seat. If we don't lead, we take observer seats. And that's the spiel. So
Great.
We focus on digital media.
And sorry about the high chair. That might be uncomfortable. Is that okay?
Sorry, I'm good.
Okay. Steve.
Hey, everyone. I'm Steve Schlafman. I'm a principal at RRE Ventures. We're based here in New York. We've been in business for almost 25 years. Like Josh and Allison, we typically play at the early stage. Our sweet spot is Series A. And I think there's really two kinds of categories of companies that we'll invest in. One is what I would consider frontier tech, so things such as robotics, space, blockchain, Bitcoin, stuff in that camp. And then things that are really native to New York, so everything from marketplaces, media, commerce, healthcare, enterprise, fintech, and so on and so forth.
So out of those, well, which one is your most favorite one? I saw a blog post recently that I'll let you translate into the type of companies that you're most interested in looking at.
Yeah, it's interesting because I would consider myself a little bit of a mutt in terms of the companies that attract me, although recently I've been thinking a lot about companies that are solving real problems in the world that aren't just kind of a cool thing, like a point solution app, but I'm looking for founders that really articulate problems that they're finding in industries that have been fairly antiquated, and that could have a social mission, or it just could be a problem that's really easily demonstrated based on their native knowledge.
Made any investments in that category yet?
I actually have. I've made a number of them that you could argue have a social slant. One in which is not really a techie thing. It's actually a healthcare services company. The company actually is changing its name, but right now it's called Recover Together, and they are basically building very low cost health clinics all over the country to combat opiate addiction. And I'm not sure how many of you know, but right now opiate addiction is one of the largest health care problems in the country. There were more people that died last year of overdoses than car accidents. And the team are a bunch of MDs from Stanford and from Dartmouth that saw firsthand a bunch of patients coming in the ER room and started to research the market to find out that to get care for these patients was super high cost, and there were often long wait line. There wasn't enough capacity, and so what they did is they basically built an entirely new model.
Okay, Allison, can you tell us about a recent company that relates to this visual tech space at any level that you have invested in?
Sure. So one company is called Samba TV.
Yeah.
Can you hear me? So they have technology in chipsets of connected TVs. So think your 50-inch Samsung, well, not Samsung, but other manufacturers. And so they, due to their technology on the chip, can read what's happening on the screen. So if it's a TV show you're watching or Netflix or whatever's on your screen, it can actually read that, and then they get a lot of data on what people are watching and what other things are going on in that household. Because they're connected TVs, they can then link that back to the digital footprint of that household and figure out what they're doing online as well as what they're watching on the TV screen. So that data is used for advertising purposes, for research and analytics purposes, for content, what's working, what's resonating.
And Josh, what about a company that we didn't talk about earlier that's in this space?
Look, there's a fund company I invested in last summer called Musical.ly. That's what a lot of younger kids are using right now.
My 8-year-old, by the way. Yes.
My nieces.
Oh, wow, look at that. I don't have any kids.
Who else has people who are using Musical.ly in their lives? Awesome.
Gabby use it?
It's in great hands.
Gabby doesn't use it?
What's amazing is people turn the camera on themselves and they can like play a song or pick a audio clip as sort of background and create a music video. And it's been amazing to see the participation rate and how many people are creating these forms of entertainment. And when you give people just a little bit of a template or a little bit of tools to go do it, they express themselves so much more richly than if it's like, hey, blank camera, go. And so Musical.ly is just, it's incredible. As you saw, all the people up here.
Go ahead.
Can I chime in, because I think the first example wasn't incredibly relevant to this crowd, but you asked me about my blog post, so I thought I would align it with that.
That's why I asked you. You're adding one?
Well, I have a few that do apply.
No,
I have one in particular that applies computer vision. I have another one that's a live streaming company.
We'll get to those. Don't worry. You got it's 20, 30 minutes left, Steve. I know we just brought you up last minute.
Getting warmed up.
Settle in. Yeah. Okay. Good. Josh, so one of the next question leading into that, young audience, how'd you find that company? Is it a trusted introduction, which most VCs say we only want to hear from trusted introductions, or was it? Did you?
Musical.ly is a great case where look, I think inbounds and introductions are always important, but just like they say, most companies are bought, not sold. I think a lot of great companies are invested in, not go out sort of pitching 1,000 people. And with Musical.ly, they had been sort of in the marketing, growing, and I'd been tracking them for a while. And I'd met a bunch of other companies in the space. Dub Smash is another very, very popular product that's similar. And when I saw Musical.ly, and I looked at a lot of people using it, and I have ways that I kind of track what a lot of.
What are those ways?
I have some data analysis people on our team that track data. We look at a bunch of stuff that happens on Twitter, and I talk to a lot of people, and I'm like, what are your nieces, nephews, kids using? Because I know that what they're using is much more of what's going to happen in the future than what I might use and discover, and personally. And so with Musical.ly, when I saw it kind of breaking out and it was rising up the App Store, I reached out cold, and we figured out how from the developer on the App Store to find his email address. And I sent them an email, and it turned out they were very quickly, they were very late in their process of signing a term sheet, and the team's actually based in Shanghai, China. And so I felt very, very lucky to sort of, we quickly I met the person who was running the business in the US. We got on a Zoom call to have a good video conference, and we moved pretty quickly in the process because they were already in process to join the round that was in flight.
What % of the deals do you reach out versus come to you like that you've invested in?
Roughly. Probably 50-50
really?
where I've reached out. But they're often relationships that get formed through meetings at places like this or other events or things that happen over time. And then at some point I'm like, instead of them saying, hey, we're going to raise, do you want to do it? I'm just like, hey, I'm checking in. Hey, things are going well. Hey, wait, why don't we do it? Or somebody says, hey, Josh, you should really go ping them. And so I'll go reach out.
Allison, so as far as that whole finding deals, typically everybody says via trusted folks. What's the second kind of way that you like? I mean, do you do what Josh does as far as reach out coldly, or do you find other ways?
We do. So we definitely reach out cold. So we have certain sectors every year we're addressing. So
what's one of them?
Esports is one category we're really interested in. So we'll go out And because we have an E-League, which is starting actually this week, watch it on Friday on TBS. So esports is a big category for us. So we proactively map out the space and figure out who are all the different companies in the ecosystem. Should we reach out to them? And then we'll just call. So we did that in online video, and that's how we ended up doing Maker Studios a couple years ago. So we do 1 or 2 of those every year where we just sort of map out a whole space and reach out to everybody. But we also... we take all inbounds. So the first deal I ever did was a photography company called Wire Image, and they were one of the first digital people to take sort of trade photography and put it online. So they did a lot of music stuff and entertainment photography and red carpets and that kind of stuff, and they were one of the first to put it online. And then people could come in and just buy the photos online instead of like contact sheets and, all that stuff. So they just called our, general switchboard and asked if we had an investment group. And somehow that call got to me and we met.
Did you just pick it up and they started pitching you right there?
No,
or
they sent us, this was like, I've been doing this
voice call. That sounds a couple years ago before email. Right.
So they sent us like an actual deck, and I read it.
Okay.
And we thought it was interesting.
Cool.
Yeah. We'll look at anything.
Steve, other than that trusted friend introduction, are you how proactive? And the reason, it seems like you're basic, but I get asked all the time, I'm sure you guys as well, how do we talk to that person? How do we get to that person? And they can say the trusted intro, but what are the other ways? So you're looking at a sector now. So how do you look at that sector and get kind of pings of, hey, that's interesting? What excites you?
Yeah, I think it's sort of a chain of events and discussions. So for me, it's like going down a rabbit hole. So like right now we're doing like a deep dive into like CRISPR's an area, which is genetic editing. And like we'll talk to someone and we'll say, who's the smartest person that that is either building or researching in the space? We'll get an intro to that. Who's the smartest person? And just by that process, typically you end up finding interesting people that are working on solving really challenging problems.
So what's each of you, after this process of getting to know the entrepreneurs, and you get really excited. So what % of the time you get really excited, you really love it, but you pitch your partners and they say no? I love that they're all laughing. That means it was a good question.
Look, for us, we did some analysis on the ones that one of the partners chose to bring in to present to the full partnership. We've done about 50% of those deals. And
50% of the ones that are brought.
That somebody is so excited about that they want to kind of nominate it to the full partnership to actually do the deal. And look, we're not a voting where if the partnership is all everybody's thumbs down, then you can't do it. We treat ourselves like an advocacy model where, look, if a partner is really passionate about a space, really believes in the company, really believes in a founder, really believes that the deal structure where we're going to invest X dollars is going to be a great way to return money to our limited partners, that partner can do it based on all the feedback. But we use the common wisdom of the rest of our group, and we have 10 partners, to kind of push back and really test, how much does that person believe? Other people might sense other things about the founder of the opportunity. Sometimes you can get so deep into something and you're super passionate about this one's going to work. And then you get the question, which is what if this existential risk happens you just hadn't thought through? And with all that feedback, you just really have to kind of go back to I have to go back to my partnership and say, given all the risks, because trust me, there is zero deal that is not fraught with risks. And if it has no risk, then you're paying such an exorbitantly high price that then the risk is, can you get a great enough multiple still on top of that? I'm willing to take the bet with all those unknowns. I believe this is the best out of all the opportunities that I see and what in my thesis and what I really believe. And I think this is a great way that we're going to have a chance to return capital. But you get all that pushback, and at some point we look at every deal and we say it's 51-49 for the individual, where they're am I just over the line where I'm going to do it, or am I just under the line? And it's never if it was a no, it wouldn't have gone to a second meeting. Once you're at a second meeting, you've already got the person intrigued enough that they're somewhere on that spectrum, and it's just where do you fall in that line? But that's
what we're trying to parse through. So, Allison.
So for us, it's more, if we really love a deal, usually other things will detract. So we might love it, but we can't figure out the strategic fit component well enough.
How much of that strategic fit is a mandate versus nice to have at Time Warner?
So we're not a fund, so it's cash from the balance sheet of Time Warner.
So it is
our shareholders'
direct
money.
mandate.
So it needs to be strategic. It needs to make sense.
Does it have to come from a group more often that says we're into this space, or does it more come from you and then finding who's the internal sponsor?
Both. So we do a lot of work with our divisions. At the beginning of every year, we do about 60 interviews with people from all over the company to just try to figure out what they care about. So then we can map against that. Sometimes they'll bring us something. They'll say, "Hey, we're working with this partner. They're performing really well for us," and then we'll take a look and do the investment. Sometimes it's just us proactively, but the difficulty does come in, is this really strategic? Does Time Warner need to own a piece of this company, or is it just a nice vendor relationship? So that's usually the part that we all discuss and sometimes disagree on.
So that's interesting. So I guess, is there a way to put some tangible understanding for the audience on
what that means?
Yeah, what does that mean? Is it really strategic?
Yeah, that's a great question. That's what we always talk about.
Well, that's why I'm
asking.
It's
more like you know it when you see it. So it's, how likely are they to work with one of our divisions? Is what they're doing, does it help? Is it game-changing for us in some way? So we do a lot in content and gaming. So is it a game that we at our Warner Brothers studio, which is a huge gaming company on their own, is that a kind of game that we'll never do first, but it's a really cool platform and technology that our IP could live on? So, but not a Me Too thing that we could already do or we're already doing. So it kind of needs to move forward.
I know it's a tough question. Steve?
This is tough.
Well, you're up here on the stage. But
it's tough because there are times where I can think of a handful of investments where, I'll do a lot of work. I mean, months and months of work, getting to know the founder, digging into the space, and I'll bring it into the partner meeting, and for whatever reason, one of my partners could be having a bad day, or they didn't do the full prep to really understand the opportunity, or they don't realize how much work I've done on the space. And so sometimes there are these factors of just like partnership dynamics that will derail an investment. But on the most part, I think, to echo what Josh said, is I feel like I'm part of a very supportive partnership where if you're incredibly passionate about something, you can get it done, but everyone is going to go around the table and share their view on whether or not it's a good investment. I mean, I can think of one company I brought in a month ago that I was really excited about, and I brought it in, and for one reason or another, I mean, most of the partners had an adverse reaction to it. And at that point, I just had to make a call, and I was like, I believe in this company, but from a values perspective, it didn't necessarily align with the rest of the team. And so what I did is I put it aside, and look, it turns out that a really high-quality firm ends up investing in the company, which I just found out. And at the end of the day, I have to trust my partners and our shared values that we're making the right decisions.
Sure. Can I add one thing to this answer? So from the entrepreneur side, I think you should try to make sure you have as healthy and open a conversation with the investor on where their partnership is and what work is needed to be done and what the confidence level is. I think there's a lot of investors who are like, we love you, 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 we love you. Sorry. And they kind of just like leave you hanging at the very end. And so you kind of get like pulled in by this because, look, as investors, our job is to learn as much as we can about companies to try to make the best investment decision. And so but if you feel like you're getting that and you're not getting the honest communication about what are the risks, what are the reasons you might not do the deal, what are the reasons what are the reasons your partners may be more excited or less excited, who are the partners who really are decisive in your firm, you should feel very comfortable asking those questions of the investor, and you should almost demand it. And if you just are getting we love you, we love you, we love you, it's going to get done, it's going to get done, it's going to get done, just come in and pitch, and then you get like left hanging, like that's not a good experience, and that's not good for you, that's not good for future entrepreneurs, and that's certainly maybe the investor got what they were looking for, but I don't think it's good for them long term.
Well, one thing that I do with any entrepreneur that I bring into the partner meeting is I will actually carve out at least an hour ahead of that meeting. I'll walk through the deck that they plan to pitch, and then I'll also walk through what I think are going to be the big concerns based on the early input that I'm getting from my partners so that they can go into this meeting as fully prepared as possible.
That's great. Allison, do you have any advice to add? Because I think it's a good topic. Part of the first half of this is talking about us as people and our jobs and how do we do and how do we help them, and then we'll talk about opportunities. But I think this is very valuable.
Yeah, I think it's always ask sort of what the process actually is, what the steps are, and where you are in the process. I mean, I've had a lot of our companies where they've been told, you're going to get a term sheet next week, and then, nothing happens. So we're always super straightforward in our group after the first one or two meetings, and then we have sort of the strategic conversation that happens, and we're just very straightforward about what we need to see for it to work. But I think definitely ask lots of questions and understand, who the person you're talking to is and where they are in their organization, and can they get stuff through, or do you need more than one advocate on that team to help you? So, yeah.
So here's I think, an interesting question we as investors always ask for companies' measurement and what they're doing, how they measure what their KPIs are. And aside from the liquidity event of an investment, how do each of you measure your progress on a monthly, yearly basis?
Our personal progress?
meaning how you're doing. You're doing a good job or a bad job? How do you measure
for
whether or
our
not you're doing a good job?
Measure all their KPIs. For us, it's
personally, in relationship on the other side of the table. How do you measure your own value?
Yeah, we try to look at a couple of things. So one, strategic partnership struck. So every year at the end of the year, we try to figure out how many of our companies have actually ended up with deals with our divisions or deals with each other or whatever, however we help them make deals happen. So we used to have a lot of divisions, now we have less, so we still have contacts. So still kind of counts. So we, all the introductions we've made, did they lead to any actual operating partnerships? So we definitely count that every year. And we're measured on that too, because that's part of what we're supposed to be providing for Time Warner. And the other thing is just stuff you personally do at the board level. Like, did you help with recruiting? Did you help with an M&A process? Did you help with, I'm always on the compensation committee for some reason.
Do you track that? I mean, are they check boxes? Entrepreneurs have to track it on a graph.
Yeah, we should probably be more precise about how we track it, but we do think about it and talk about it in our group. Yeah.
Steve, Josh?
Something that it's actually a really interesting question because I have an Evernote doc right now of ways that I think venture investors can better measure their impact and input.
Share it.
Yeah.
And it's actually a combination of both qualitative and quantitative, and obviously there are returns that we have to provide to our limited partners, and I would say that is arguably the most important because without that we don't necessarily we're not in business. But I think there are some really important ones, and in fact I went to our head of platform 2 months ago. I was actually on the road and I had this idea, so I pick up the phone and I call her and I was like, we should institute a scorecard.
Yeah.
Internally that basically tracks what we're doing for all of our companies. And so that we can every quarter look at it and saying, what are we doing for all of our companies? And that it's across a number of categories. So it's things like hiring, business development, financing, and PR and news. And that way it's keeping us honest that we're delivering value to what I would argue our most important customer, which are the founders we get to work with.
So I've been starting to do small steps towards that as well. That's why I ask. So now here's the tough question for that. Before I go to Josh, if you thought that was tough, will you share that with the entrepreneurs to see if you're accurate?
Sure. Yeah. I mean, I actually take an approach where I try to be very open and transparent. And it's something that we're just starting to institute now.
That's great. Josh?
As investors, we can't always control the returns. I mean, we're backing great founders, and they're responsible for building great companies. We do everything we can to help, but we recognize that, our help is more like a little bit of a guiding hand and a couple of great introductions here and there. But fundamentally, the returns that we get are going to be based on the picks that we make. But the thing that we can control is we really can pick the journeys that we go on, and we know that we think we can pick the journeys, but really it's people picking us. And so the only way that I can kind of measure myself along the way is like, am I getting more successful at being able to find and meet the people I want? And do I feel like after I meet them, they're more interested in wanting to work with me? And I try to do that kind of, how do you just like try to win every meeting where at the end of the meeting, you feel like, wow, I would love to see that person again. And they express that in some way back to me. And when I then meet somebody I really want to work with, I'm like, I'd love to work with you. Do they say, I'd love to work with you too, or do they kind of stone face me back? And like those are the little ways that I measure whether it's working. And then the founders that I work with, I try to track the chatter that I hear. What they tell me is one thing, but what they tell other people, whenever we try to do a deal, we say, go reference us. I'll give you the names and emails of every single person. I'll make introductions, but I'm not trying to leave anything off. And if you find anything anywhere who will reference Greylock, please ask them. Give them all the good and the bad, because I stand by the work that I do and the people that I work with and have worked with in my career, and that's almost the only thing that we can really measure ourselves by, and in hopes that the journeys that we're picking turn out to be great ones.
Yeah, I think one other metric that I think is probably most important is with repeat entrepreneurs that we have funded and whether they would come back to RRE for money, and to me that is arguably one of the most important metrics we should use to measure our success.
And it's interesting when entrepreneurs who are successful then go to a totally new set of investors the next time. I've seen it a few times. Super interesting.
And just to flip this back to advice, do references. It's not that hard. It's really important, and you will learn a lot by talking to people who've worked with the investor before. And if somehow you're not getting to somebody because the investor won't connect you there, or other people won't, or they will say very, very soft things, that's a sign.
Actually,
and the person, not just the fund.
Take it to
the person, not just the fund. But if you're having trouble getting there, or they say, yeah, I liked working with them, and like that's always a sign.
To take it to the next level, I learned something years ago where you can do reference checks on Broadway or off Broadway. So on Broadway are the ones they give you, which you don't really need to call. You should call the ones that they don't give you, that didn't work out. And the ones that didn't work out, unfortunately, you learn the most from a collaboration in business from those that did not work out, and whether or not in the end result you'll learn what it's like to work during bad times, which is the hardest part. Transitioning the opportunities, where do you folks believe, we've talked about content and visual tech across the board in some of your portfolios, where will computer vision disrupt the most in the next 5 to 10 years? And our computer vision along with AI, but with some vision part, what sectors, therefore, which will be the biggest opportunities that excite you or intrigue you? Who wants to take it off?
I'll start. Look, it is crystal clear that, we talked about this before, VR and AR are going to happen, and the set of computer vision techniques needed to place us in the scene. We just saw that with Simile, place us in the scene, understand what's going on. If you've seen the Magic Leap videos or demos of, I could be looking at the crowd and seeing like little butterflies and lots of other funny things happening out there right now, and you guys would have no idea because it's all in my glasses. Like, there's just going to be so much creative computation that's about to happen here, and why doesn't it tell me the name of every single one of you, and the fact that like 3 of you might have worked with somebody who I know very well, and we might have like 10 mutual friends. Like, that's all about to happen.
So you'd like numbers right above everybody's head right up here, so you can know directly where you're going to go?
Exactly. And that's where VR and AR are going to go. And I think the computer vision stuff, it's finally, our data sets are trained. Like, we know how to have you guys have tried Google? How many people have tried Google Photos? Okay, like you literally type in hugs, and I almost cried, just seeing all the hugs of my family, and it's amazing now that it can just do all this recognition. Now that works, now there's a whole set of great new opportunities on top of it that we can't even imagine yet.
Allison?
So we're investing in VR and AR. I think it's going to be a long journey, to use the journey term. I don't think, right now necessarily there are so many monetization opportunities, but we've invested in a company like NextVR, for instance, which does live VR. And for us, it's all about sort of storytelling and putting you in a place that you can't necessarily be. So they do a lot of live sporting events, so like being at center court for a basketball game, or being, we did a presidential debate on CNN in VR, which maybe you want to be there, maybe you don't. But so putting you and giving you a different point of view. So I think, our guys are really focused on how can we enhance our storytelling through technologies like VR. I think it's experimental right now. So, CNN loves the idea of putting you in the news, which seems really cool. But not that many people have the right devices. And I think we're going to have time to figure it out. But I think, we want to try some stuff.
2 to 3 years, 5 to 10 years, 10 to 20 years.
I'm more like in the 5 to 10 camp. Okay. I mean, I love it as just a person.
For masses.
From a science fiction standpoint, like, if you guys haven't read Ready Player One, that's a really cool book, and we're making the movie on that, and so we're going to do a lot with Magic Leap and other companies. Steven Spielberg's directing. It's going to be awesome. But I love the concepts of it. I just don't think it's necessarily here right this second, but maybe 5 years plus.
How many years out before Steve goes? 5 to 10, 10 to 20?
VR is 3 to 5, AR is 5+.
Go.
I'm fascinated by industrial applications, and so around areas like agriculture. So we have an investment in a company that's building large-scale indoor farms, and one of their core pieces of technology that they're developing is computer vision that basically is placed above a grow bed and then analyzes the development and then feeds that back into their operating system. And so over time, that system is going to get really, really smart, and they're going to be able to optimize a bunch of the yields and all that stuff. And then another area is around healthcare and being able to do diagnostics around imaging and things of that nature. And we're looking at a bunch in that space as well.
So in the agriculture space, how long will it be until in New York City, every other 2 or 3 floors in a high-rise is a farm?
I think that's pretty far away. But if
that's exactly the business.
Let me sort of answer it a different way. I would say in the next 3 to 5 years, there will be tens of thousands, if not hundreds of thousands, of square foot dedicated to indoor farms around the Metro New York area.
We've got about 5 minutes left. Who's got questions over there? One of our competitors, Anthony. Speak up and put the mic on. Not you, them.
Is it on?
Yeah.
Good. So my question is around responsible investing. We're seeing a lot of entrepreneurs who are taking on way too much money, in my opinion. And I've experienced it myself with where investors are like, hey, you're not asking for enough. And it worries me that I think entrepreneurs are making decisions to get a hold of a lot of cash. And I'm wondering, at what point do we sort of, do investors sort of play a role in being responsible investors so that we can focus on being resourceful and getting far with, $700,000 in 4 years in our example, and are you guys valuing that in entrepreneurs these days, or is it, so it's kind of a 2-part question there. Thank you.
I value that. I've been through companies that have raised way too much money, and if you raise way too much money, you'll spend too much money, and it just creates, if things don't go perfectly, really bad incentive in the future when you've raised too much at too high a price and you can't live up to it. It makes it really difficult for everyone, including the team, who's buried under a lot of liquidation preference and may have wanted to take an offer to sell the company at a certain price, but it doesn't work because they raised too much money. So I think just being rational. Like, I've been on boards where we've had inbound offers for money that we didn't think we could spend. So decided not to take it, even if it looked great on paper. If there wasn't a good rationale for using the extra $40 million, maybe you turn it down.
I just had a conversation with a young founder this morning who is deciding kind of, do I go raise a lot more money, or do I kind of get my thing to light profitability? It's sort of an ad model, and you can get to basic profitability and then figure out where the scale takes him. And the conversation we had was all about what it means to take on the money and what it changes your expectation set. And look, I don't think the people who raise too much money would tell you at the time, or some would say they raised too much money, and maybe investors would, maybe people around it would. but they would say, I'm ambitious, and I think in order to achieve the level we need to in the world, we do that. I think there were some companies that got overly aggressive in spending on growth as opposed to spending on really durable, sustainable growth, which is like, to me, that's really the important conversation to have is like, are you growing in a way where you're retaining users, where you're retaining customers, where you're basically profitable, or you're doing things that will get you to a point at which you'll be basically profitable? I think some people fooled themselves into thinking that that was happening, that it wasn't. But I'm not sure on the other side that like the really resourceful person who's bootstrapped their way to something is necessarily the right venture return type of investors, because maybe they're actually missing the fact that actually if they were to spend more and go faster and be more aggressive, they could actually get to this sort of promised land of the big independent durable company even faster. So I really think it's a conscious conversation. We had a company that got a great term sheet to raise tens of millions of dollars. And I spent a lot of time going like, I don't think the time is now to raise the money. I think you can raise a lot more later. And you came to me like wondering about M&A not that long ago. And like maybe we should actually sit through and like, let's get the company to a point where now it's going to get big or not. And he said, look, actually the past couple of months have taken me through this process. I'm now ready to go big or go home. And I know what it means to raise this money. And I believe that we now have the metrics and the things that are working. And I looked at him and I just said, are you sure? And he looked back and he said, I'm sure. And I said, great. Like, I'm supportive of what you want to do to make this the biggest business possible. But it was an honest conversation. And I think every time that happens, it's great.
Yeah, I mean, I've worked with companies on both sides of the spectrum. And certainly anytime I choose to work with a company and a company chooses to work with me, there's a level of trust. And as part of developing that trust, I always sit down with the founder and the team to understand like what's the amount of capital that they need in order to really get to that next level and achieve the things that are really core to that business. And like I think the founder of Recover Together, Jeff's a good example where he was incredibly lean. And I think initially we wanted to do a smaller round, and he came to us and said, look, I'd actually like a little bit more powder because I think I can get much further with not a lot, much more cash. And so like that's an example of one, whereas there's others where it's just a very aggressive founder where he's just like, this is the opportunity. It's a land grab. We have our shit proven. Now we need fuel for the fire. And I think in some cases you just have to get out of the way because some founders are just going to do it out of sheer will.
Quick question over here.
Great. So first of all, great discussion. Thanks so much for being on the panel. My name is Justin Wayne. I'm a graduate student at MIT. And my question is around concerns for the price tag of some of these new visual technologies, specifically how it relates to access. And so I'm curious to get your thoughts around what we can do as a community to ensure that these really awesome and amazing tools are made available to as many people as possible.
It's a great question. Look, I'm gonna twist the question a little bit. Like I think these tools are computationally expensive, and there's actually real cost of what you're paying for these days. The thing that scares me more than just the tooling cost is the data sets and like how accessible the data sets are. The big companies, Facebook, Amazon, Apple, Google, they have really giant proprietary data sets these days on almost everything that's happening. So like Google can train a gajillion images on hugs, and then all of a sudden they can have this great product. And it turns out to be a startup building something, you can't do that because you don't have the training set. So I'm actually more worried about, like, I think the tools and costs of something. I mean, the cost of computation used to be you had to give a company $5 million so they could buy a whole bunch of servers and room in a data center and go rack it just to have a freaking website up. And today, with like hardly any dollars, you can be up on Amazon Web Services. So I think the cost of tooling is going way down. But I'm really worried about this training set data, that we're not going to be able to have innovation happening at the bottom edge anymore if the big companies harbor all the data.
Yeah, I was talking to Josh's point, I was talking with a company yesterday that is doing sort of artificial intelligence and machine learning around mental health. And I think the company said that they want to raise like an additional $1 million to be able to train that data set and really refine it. So that's an extra $1 million that in an app world, right, when you're just building an app, it wouldn't necessarily have been needed, but they really need to train the tech that they're building.
Okay, we're winding down. This is great. So we're going to end it on a one-sentence advice from each of you relating to people that want to raise their first external funding. One sentence of advice that they should do. Who wants to start?
Build relationships early.
How early?
As early as you can, as often as you can.
Great.
I think just know exactly who you're talking to when you're talking to them, so you can sort of be relevant to the person across from you and know what other deals they've invested in or haven't invested in.
Okay.
Be fucking awesome.
Okay, on that note, thank you very much. That was great. Steve, thanks for joining us.